drawdowns for me does not automatically mean I'm holding a stock and it's going against you, or my whole portfolio is going against me. I'm a trader. I'm not an investor. So that means I can also lose a couple of times in a row. Losing, 5 times in a row, 7 times in a row is absolutely normal for me. So trying out which works in the market. So, and when I'm in a drawdown, it's not a big issue. I learned that over the years for me that that I have enough conviction in my abilities as a trader and also in my trading system that I can make a comeback. What more frustrates me than sitting in a drawdown, to be honest, is if I make mistakes. This is what really drives me nuts. Or for me, it was more like, learning how to deal with your emotions through the time, distracting yourself, not thinking about that, having something outside of trading, outside of trading to distract yourself. And this is something you learn over time. There is not this one secret concept or whatever where I can say, okay, this is something you have to apply, and then you can deal with drawdowns. It's more like, okay, you suffer a lot of drawdowns. You go through them, you learn from them, you find out more about yourself. How are you dealing with that? The trader destroys their own edge. It's not a big issue to find a trading system that has an edge. Trend following, it gives you a basic edge, and you can build rules around that and make money with the system. So, but it's a trader that has to execute the system. The trader itself is the biggest enemy to become successful. It's mostly that you destroy the edge by making mistakes, emotional mistakes.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey, this is episode 305 on Chat with Traders. Thanks for tuning in. Tessa here with my co-host, dear friend, and awesome interviewer, Ian Cox. Although I trade options and have added index futures to the mix recently, my introduction to trading way back began with stocks. Stocks are really the backbone of how I think about trading. Options are built on them as the underlying, and equity index futures are ultimately tied to baskets of stocks. So for me, everything still comes back to stocks. So if you love trading stocks, this episode is for you, because today Ian chats with Julian Komar, a seasoned German trader with nearly 2 decades of stock market experience. Growing up in Germany without a financial background, Julian became fascinated by stocks as a teenager. He moved past complex German trading products to concentrate on U.S. equities. Specializing in momentum and growth stocks on the daily time frame, he blends fundamentals, technicals, and story analysis to uncover opportunities that put him in the best position for high potential setups and riding powerful trends. As a disciplined breakout trader, he prioritizes risk control, market trends, and intuition gained through decades of experience. We've included more information about Julian in our show notes. So without further ado, ladies and gentlemen, please allow me to introduce Julian Komar from Germany.
Julian, I'd like to welcome you to Chat with Traders.
Thank you very much for having me.
Where are you? You sound like you have an accent.
Yeah, I'm very much in the north of Germany. So I'm living close to Hamburg in Germany for my whole life. So I'm originally from Germany, and that's why you maybe hear the accent in my voice.
So tell us a little bit about what was it like growing up in Germany, and especially as it relates to your interest in the financial markets. Kind of how did you get exposed?
I don't have any comparison to other countries, how it is to grow up there, but I can talk a little bit about my own journey. So I was always interested in finance, and I'm not coming from a financial background, and also my parents and where I grew up have no financial background. So, but I got very interested in financials and also in stocks when I was 16. So I'm 39, by the way. And that was also the first time when I bought a mutual fund. Very classical, I walked into a bank and said, "Okay, I want to invest some money, and what could I do?" And that was the first time when I got in contact with banks and also consultants, financial consultants. And I remember one thing, and this is always in my mind. I asked them after I bought the mutual funds. I asked them, "Okay, you will call me if these things go down." But guess what? They never ever called me, and that was also a key event where I learned, okay, I have to take care about myself. At the time, a lot of people got interested more in stocks. One of the biggest names at the time was Deutsche Telekom, so a communication company at the time. But then, of course, around the 2K, so around the 2000 crash, etc., all the Germans went away from everything what has to do with investing. But I still, I was very interested in that because I saw that always as a challenge. And I got more and more in the direction of stocks. In Germany, we had a lot of different trading vehicles, and I tried them out all, to be honest. I traded CFDs at the time. I traded something which I think only the Germans have. It is something like certificates. So you can buy a certificate, and it could also be a leverage certificate or a leverage option, something like an option. And I also tried that out. And at the end, I got into stocks and got more and more interested in stocks because I was always fascinated by technology companies and in general, getting to know companies and trying to find out more about companies. And that brought me in the direction of stocks. Then I traded mostly German stocks, European stocks, and later then I discovered the US market, which I trade only. So I only trade US stocks.
Was the main thing that got you into stocks because you like the story behind the companies? Or, I mean, how did those other products go for you, those German trading products? Was it difficult to connect with, or they, tell us a little bit about them?
Yeah, they are very complicated. So these certificates, as an example, they give you a lot of leverage, but if you are an inexperienced trader, you have a lot of ups and downs with that. And it's complicated because they have very similar characteristics like options. So you have something, like a strike price, etc. But they are not traded on a regularly option exchange. And it was very, very complicated. And that's one of the reasons why I walked away from that and focused more on stocks. And as you said, I was very interested always in the companies itself. What are the companies doing? What is their business model? Why are they successful? And I'm coming from a technology background. When I was 16, I got out of school. So I have no high school diploma or anything like that. So I got out of school when I was 16, and I got into a traineeship. I started to be a media designer, and that was also the time when I got connected to a lot of technology topics. Companies like iOmega, Adobe, and so on and so on. People who are 30, 40 years old maybe know the stocks and also know the companies. And I always had some connections with them. And that also brought me, of course, in the direction of stocks and more technology stocks and innovative companies, because I always felt connected to them. And I always got interested in, okay, what are they doing? What is the story behind that? What makes them successful? And what are the products that they develop? And after my traineeship, I got more and more also in the direction of product management. And that's why I always had a connection also to what are companies doing, what is the product? What makes the product successful? What are people like about the product? And this is something I use still today for my stock trading. You know, I'm always analyzing the story behind the company. I'm always analyzing the fundamentals behind the company. I want to know why something is successful. And that always leads me in the direction of finding high potential stocks.
How far down the rabbit hole did you go with analyzing company fundamentals? Did you focus a lot on that? I mean, were you into the technicals early on, or kind of how did your early journey with that go?
I always go through 3 layers. So technicals is always the most important for me. There is one reason, a very simple reason, that the stock exchange trades the future, not the present, right? So, and the technicals itself, and when I speak about technicals, it's about relative strength. So how performs the stock in comparison with the indices? How is the accumulation of a stock when you watch the volume or when you watch other indicators? And you know, the technicals always show me what are the big institutions doing, and this is the first layer. I'm always looking at that to make sure that institutions are accumulating the company and have a high demand for that. So, and when the chart and the technicals appeal to me, and when I say, okay, this is something which could be interesting, I want to find out what are the institutions seeing that I am not seeing right now. And then I'm go to the next layer, the fundamentals. So in fundamentals for me means always growth. I want to know how is the company growing in sales, and if the company is profitable, also in EPS. You know, a company which is growing fast, like 20%, 30%, 40% in sales year over year, that is catching my attention. That is something where I go to the next layer, to the story, because I want to find out what drives the sales. You know, what is the story behind the company? Why are people buying the stock and the products of the company itself? So, and I'm always going through these 3 layers. But, and this is something I found out over the years in my trading career, there are different times in the stock market, and there are also different types of stocks in the stock market, and not in every stock market cycle the same type of stock attracts the big money from institutions. So there are some times where, you know, more typical can-slim stocks, so that means stocks that have big earnings growth, big sales growth, big future estimates, etc. That there are times when these type of stocks are in demand and people want to buy them. There are other times where what I call sales growers are in demand. So companies usually having only a big sales growth and reinvesting all their profits into the sales growth, so into growing market share and into growing the sales of the company. And there are other times where more story stocks exploding in the market. Sometimes companies that have no sales at all and also no EPS at all. And I'm trading all these 3 types of stocks, but I'm always going through these 3 different types of layers to find out what are investors and institutions seeing that I don't see. You know, it's a little bit like a detective game, or it's a little bit like a big puzzle. And this is what I enjoy. You know, I spend, I would say, 90% of my time doing research and try to find some great stocks in the market.
So can you give us an example of these different types of markets that you encountered throughout your history, and share with us, you know, some examples of the stocks that highlighted that particular time period?
Yeah, sure. I mean, if you think about NVIDIA, for example, right? And NVIDIA was always a company which came from a total different business. They transformed their business in the last couple of years, became very successful with their products. So with these, with the GPUs for AI data models, etc., they had an enormous growth in EPS, so in earnings per share, and also in sales in the last couple of years. So this is a typical can-slim stock, right? And there are market periods like 2020 or even before 2020, you know, 2017, 2018, where a lot of where NVIDIA was very or heavy in demand in the stock market. So this is one type of a typical canceling stock that I traded, or Tesla is also one of them. So mostly companies that you know as mega cap companies or also as large cap companies today. And sales growers are companies that are mostly a little bit younger. So especially in the, let's say first 5 years after their IPO, because they are reinvesting all their profits into growing market share and into growing sales. So one good example from the past I remember is Zscaler, CrowdStrike. So cybersecurity companies that you know. Coupa is also one of them, which came up in my mind. That's not listed anymore. So companies, software companies that grew extremely fast but were not profitable at the time. And and storage stocks, I'm trading this year a lot of storage stocks. One of the storage stocks that comes up in my mind is AEVA. AEVA, ticker symbol AEVA, is a LiDAR stock, and I discovered that very early this year. It's not a pure storage stock, to be honest, because they also have a big sales growth and some EPS growth, not so big, but huge sales growth. And the first thing what caught my attention with AEVA was really the technicals. It made a big move. It created a wonderful high tide flag pattern. And I saw that in the charts. And then I got deeper into the stock and tried to find out, okay, why is the stock exploding so much on the upside? And then I found out about their LiDAR technology. Then I got deeper into that and I thought about, okay, what are application areas of LiDAR technology? And then you automatically come to areas that are, future big growth areas like robotics, like self-driving cars, like drones, etc. All of them need LiDAR technology. So, and then you look at sister stocks like Allstar, which also had a big move this year. And then you find out, okay, the sister stocks are doing good as well. So, and then you discover a stock like that, and then you enter it. I'm mostly breakout trader.
How important is the sister stocks in helping you determine whether to get in on the main stock? I mean, is that a very good sign when the sister stocks are also moving in that direction? Do you look for other companies to trade as well?
Absolutely. You always want to stack the odds on each other, right? You want to increase the odds to make a good trade. And it starts with a market. If you have the market on your side, that's great. If you have the sector or theme on your side, it's great. If you have the sister stocks on your side, it's great as well. I always say to people, you don't want to trade a lonely survivor. A lonely survivor is a stock, where all the sister stocks are going down, but only one stock is moving higher. Sooner or later, it will follow the other sister stocks. But if you have a stock and you see that multiple stocks from the same theme and sister stocks are setting up in the same way and moving higher, it increases the odds dramatically to make a good trade. And you always want to look at that. So I rarely trade a stock which is moving higher, but the sister stocks are not moving higher.
So how do you determine who's the leader of the pack of that group and focus in on that? Is it just looking at market cap size or what?
No. Market cap has nothing to do with that, in my opinion, and also my experience. It's more relative strength. So what is the fastest mover? What are institutions accumulating the most? You can see that in the volume. If you see big spikes in the volume and you see a big price move, you can assume that there is a heavy accumulation going on. And very often you can see that. So if you look, for example, at AEVA and Allstar, so two LiDAR companies, Allstar was moving higher, but not so strong. AEVA was the leader because it was already broken out of their consolidation. It was moving higher on high volume, etc. It also had better fundamentals at the time. And so technical leadership is very important to find out what is the leader. And the second thing, and this is more difficult to be honest, is to find out, okay, what could be a leader from the fundamental and product side. And this is very difficult, to be honest. From the fundamental side, it's easier because you have some companies that are growing faster in sales or maybe have better EPS numbers, but it always should go hand in hand with the price. But from the product perspective, it's almost impossible because, I'm not a specialist of LiDAR technology or I don't know, semiconductors or whatever. I can only try to find out something in interviews on YouTube or when I listen to conference calls or something like that, but it's very hard to find that out. So technicals is really the most important way to find the leader in stocks. Yeah.
I see. So the leader shows itself just through the technicals. Yes. But then couldn't that mean that maybe a super small microcap could show up as they quote the leader because it's having interesting technical, chart patterns? But how do you determine that? Do you have a minimum dollar volume size per day to say, okay, well, this is sufficiently big enough because to where the institutions can get in on this stock?
Yeah. I definitely have thresholds. So it really depends a little bit on the theme itself and also on the stock. Not automatically the stock with the highest market cap is the leader. Very often you find younger companies that have, more innovative technology, etc., that become the leader. But one thing what you want to make sure is that the stock has institutional quality. So I call that institutional quality. And that means it has enough volume for institutions to get on board. So my threshold, it really depends a little bit on the theme, right? Because some themes are not mature enough, and then you have micro caps and nano cap stocks. But other themes are more mature, and then I want to see 20 million or maybe 100 million US dollar traded volume per day. So if you multiply the price with the average volume, then you have the dollar volume or turnover in a day. When you have a very, let's say a very young theme like drones, you don't have the big drone company right now. There are a lot of very small, let's call them startups with 300 million market cap or something like that. Then I also go down to, let's say 5 or 10 million US dollar traded volume per day. But everything below that is hard to trade, to be honest. And when it comes to price, of course, I prefer higher price stocks, something like 10, 20 US dollar. But in some themes, you sometimes have a leader that only trades at 4 US dollar, and that's also fine to me. So for me, the liquidity is the more important aspect when it comes to finding good stocks. But it's not automatically the stock with the highest liquidity or market cap that it's the leader, because over time, some stocks also, I don't want to call that get over-owned, but they are not the leaders anymore, but they have a lot of market cap and institutions are just buying them because they need a very high liquidity. But then other companies are catching up. We see that right now, for example, in cybersecurity stocks. CrowdStrike is not the leader anymore. For me, it's more Rubrik or maybe Zscaler. They are catching up right now with newer technology, with newer products, and they become more and more liquid over time. While the big ones are rather slow movers and they have older technologies. Money is always rotating in the stock market. So that's why I'm also focusing on lower cap stocks.
And so while you're looking at the big whales, are you keeping an eye on all the small companies in that sector and patiently waiting for them to catch up? Do you have a certain threshold that say, okay, it looks like these big cap stocks are not performing as well, and I see these younger companies are now having a bit larger relative strength than in the past, and are those the metrics that trigger you from jumping in from one company to the other, or are you also heavily dependent and looking at the fundamentals and what's going on in the news and the quarterly earnings, that kind of thing?
There are different dimensions on this question. So maybe let's start with how I'm discovering companies. I'm a bottom-up trader, so that means I'm running through my scans at least once a week, sometimes also multiple times a week, but mostly on Fridays I'm doing the big screening stocks routine. So, and I see what the market delivers in the screeners. What are the stocks that match criteria? And I have different screeners, so more technical screeners, more fundamental screeners, and I see what is coming up. And when I see that, multiple stocks from the same theme or sector are popping up in my scans, then I'm getting more interested in that and try to find out what could be a leader. And inside these scans that I'm running, I have some basic criteria when it comes to relative strength, as an example. I run the most scans in market search. So the software from IBD. I also use some investor business daily criteria in these scans, like the RS ratings. So they are rating all the stocks that they are tracking by the relative strength. And this is one of the thresholds. I'm not looking at stocks with a relative strength rating below 90. So that means it outperforms 90% of all the other stocks tracked by Investors Business Daily. So this is a basic criteria.
Were you using this format and when you were in the market like 20 years ago? I mean, because you've been in a long time, and how did this evolve over time?
Yeah, definitely not. So I learned a lot in the last 20 years, and I learned more and more and more to find out my own approach. How did it evolve? I started, as I said, I started mostly with German stocks and then European stocks. So I found some traders over the time where I learned a lot from. I learned from one guy, I learned risk management. From the other guy, I learned screenings for stocks, story analysis, and fundamentals, etc. And, I always found out, okay, what works for me? How can I come closer to the biggest winners in the stock market to find them? And I learned almost everything from other traders over the time. And I developed my own scans, because I did a lot of research about my own scans and about the companies that I'm trading. And I always try to find out, okay, how can I come closer to the biggest winners in the stock market? It's a big evolution process over time. You always learn something. You get feedback from the market, or you learn something from another trader, and then you see, okay, is it working with my trading approach? Is it also compatible with me, with my personality? And then you test that and you find it out. And if the answer is yes, then I'm using that also in future. I'm trading differently than 3 years before, and I'm also trading totally differently than 20 years before. I think trading is an ongoing journey, and you always learn something new, which you can include into your trading. And that makes it also a lot of fun and a lot of enjoyable for me.
How did 2008, how was 2008 for you? And what were you trading back then?
There was 2007, 2008 was a financial crisis, right? Yeah, I can remember. I always remember one thing, and that was shorting bank stocks. But to be honest, I was more an inexperienced trader at the time. So 2007, 2008, I was trading European stocks. I can remember that I shorted Netherlands stocks, BAM Group was it, and it was moving down very, very fast. And I learned a lot about bear markets, of course. And I remember one thing very, very good. And because I recently repeated that also and told that to other traders when we had the big correction this year. Volatility is something which is or can be extreme in down moves. You can wake up one day and you see the index is down 10%. And if you have a lot of exposure during this time on the long side, as an example, you can lose a lot of money. So, and this is what I learned in the most bear markets. But I'm not a long-term investor, so don't confuse that. I'm not a typical canceling guy. So my typical holding period is weeks to months. I'm trading more position trades and swing trades. When I'm in a bear market, or when the market is in a bear market, I'm mostly in cash or I'm short. So, and this is what I learned also from all the bear markets. Doesn't matter if it's 2007 with financial crisis or another bear market. It's the best way to be in cash or to be short. I mostly short sector ETFs, indices, or commodities. Sometimes also Bitcoin, but rarely stocks, to be honest, because there is always this crazy supermarket mentality in the stock market that people are always buying stocks when they go down, and you have a lot of choppiness in individual stocks. And on the other side, I'm also not shorting individual stocks a lot, because you can have a buyout and this thing gaps brutally against you, and you can suffer big losses. So I'm mostly in cash. That's what I learned from the last bear markets. I'm mostly in cash or trade, sector ETFs or indices on the short side.
So in one of the quotes that you have in the paper that you shared with us, you said that you like to focus on the ability to sit through drawdowns without stress. So how do you do that?
Focus in drawdowns without stress is mostly being in cash, to be honest. So, I mean, drawdowns are normal periods, right? So let's say it different. So drawdowns for me does not automatically mean I'm holding a stock and it's going against you, or my whole portfolio is going against me. I'm a trader. I'm not an investor. So that means I can also lose a couple of times in a row. Losing, 5 times in a row, 7 times in a row is absolutely normal for me. So trying out which works in the market. So, and when I'm in a drawdown, it's not a big issue. I learned that over the years for me, that I'm that I have enough conviction in my abilities as a trader and also in my trading system, that I can make a comeback. So what more frustrates me than sitting in a drawdown, to be honest, is if I make mistakes. This is what really drives me nuts. I have not a big problem to sit in a drawdown and come back after time. Sometimes I'm sitting a couple of weeks or even 3 months in a drawdown. So drawdowns, by the way, means also you're sitting in a sideways period, where your equity curve is always going up and down and up and down. And then you hit one big winner or 2 big winners, and then you are coming back, and your equity curve is printing a new high. So, for me, it is more like, or for me, it was more like, learning how to deal with your emotions through the time, distracting yourself, not thinking about that, having something outside of trading, outside of trading to distract yourself. And this is something you learn over time. There is not this one secret concept or whatever where I can say, okay, this is something you have to apply, and then you can deal with drawdowns. It's more like, okay, you suffer a lot of drawdowns, you go through them, you learn from them, you find out more about yourself, how are you dealing with that? And today it's absolutely normal for me.
Yeah. So share with us, if you can, during what time period did you have your worst drawdowns, and what did you learn from that process?
My worst drawdown was this year, to be honest. My worst drawdown was the January 27 this year, where we have this deep seek event. I was heavily invested in data center stocks. And then out of a sudden, almost everything opened with a gap down of 20%. So, and I was really, I remember the day very good. So I was not very shocked at the beginning, because I'm I'm waking up here German time, so that means I have the pre-market very early here in Germany, and I woke up this morning and everything was down 7 or 9% in pre-market, and I said to myself, yeah, okay, let's see what will happen. And then when we came closer to the opening of the session, everything went down 15, 17, 20%. You know, I held all these stocks at the time, Vertiv, Celestica, and so on. And then the market opened. A lot of stocks opened down 20%. Then they bounced a little bit, and then I started to sell my positions one after one. And on the day, I was down 17%. So that was my worst drawdown ever. And you know, personally, of course, you know, it feels terrible, to be honest. But it's not the money, or it's not the drawdown itself which feels terrible. It's more like I made a mistake. That is one point, and I will come to that in a second. But the other side, the other emotion that came up in me was I lost. That's what I always say. I lost a championship. I lost the championship against myself. This is I was exactly in the right stocks. I was trading, in my performance zone at the time. And then out of a sudden, this event came, and it really felt like, okay, I lost the championship. So that was a feeling. And then a couple of days later, I was trading again because I saw some opportunities. So, and the mistake that I did was I was too heavy involved in the same type of stock, but not all of these stocks were coming from the same sector or industry group. I traded nuclear energy stocks at the time, data center stocks, semiconductor stocks, but they all were connected to the same theme. So, and that was a big mistake. I learned from that. Today, I don't trade more than 3 stocks at the same time from the same theme, industry group, or sector. And that was definitely a big learning opportunity. Again, this is the feedback the market gives you. And you have to take this feedback, and you have to sit down, do your homework, get confidence again, and then come back. Yeah.
Mm-hmm. Interesting that you had been in the market for over 20 years and only very recently discovered this issue and then made adjustments.
I would say, I don't. I have been in a lot of different situations where the market really gap hard against me. I have been in dramatically gap downs also against me. But there was one thing which I never discovered in the past, and that was, that my whole portfolio was gapping against me. I have been in situations like the flash crash. I have been in situations like Fukushima. I have been in several situations. I have been in a gap down 50% against me with Credo technology, which came up in my mind on earnings. I have been in a stock which was moving down 70% intraday, and I got stopped out at the right time. But I never experienced a situation where my whole portfolio was gapping down. Everything in my portfolio was gapping down. I never experienced like that. When you have, when you have a situation like Fukushima or something like that, you have some stocks that make bigger gap downs against you, and some stocks are not making bigger gap downs against you. So, but I have never been in a situation where almost everything what I own gapped so hard against me. And that was really a unique situation for me and something new to learn, right?
I noticed on the documents that you sent us that you're diversified in quite a few areas, including Bitcoin and gold and silver. Was that an after effect of your experience earlier this year?
No.
As the effect of diversifying, or had you been in those assets for quite some time?
No. Again, so I'm usually holding stocks or also commodities more weeks to months. Winners, I hold a couple of weeks to maybe 3 months, 4 months, something like that. Losers, I sell within days. So, and last year, it was a great market for gold, to be honest. We had big trends in gold. And that was one of the reasons why I traded gold. It was a leading market for me. and I was able to place very good risk reward ratio bets. When you can put in a stop loss of 1% in gold, then you can trade a big position size. And gold also, I would not call it diversification because I'm not diversifying my portfolio, to be honest. It's more like, there is a great market which is on the move where we have momentum, and it can move a little bit more independently from the stock market. That's why I sometimes trade also commodities. Yeah, Bitcoin is also something I'm trading when it offers the right setup. The setups that I'm trading, they appear in all of different markets. There are some markets which I don't trade. So Forex is one of them, because they are moving a little bit differently. But Bitcoin, gold, sometimes oil, especially on the downside. I personally like to trade oil more on the downside. They can sometimes set up in the right way, and then I'm trading them. But I'm never looking at my portfolio in case of diversification, something like that.
Mm-hmm. So let's talk about the setup. What do you look for exactly in the setup, and what triggers you? Because in those documents you sent us, it looks like you can go long periods of time just during your drawdowns or flat performance, waiting for the right time to go in big. And you mentioned in these documents that you'll use margin to. So when do you do that? What exactly triggers that action?
Yeah, first of all, I'm running my own market trend model. That's important. Mm-hmm. I also not invented that by myself. I tweaked that, but I also learned that from another trader. This is very important to find out, when do I have an edge in the market and when not. So, and it's a very simple trend model based on moving averages. And when I see a good trend in the stock market, so when my market trend model switches to green, when I see that there are a lot of stocks reaching new highs and we have a higher number of stocks above the MA 200, that's a time when I'm becoming interested in trading stocks. So, and then what I'm basically looking for is a stock with a high momentum, creating a good pattern. So, and what are the patterns that I'm trading? It's very basic stuff, right? I'm trading flag patterns. I'm trading tight consolidations in a chart. When a stock, when a stock makes a big move, like 50 or 70% in a short period of time, and then it gets very tight and starts to consolidate around the exponential moving average 8 or exponential moving average 21 that I use, and builds a very tight consolidation, that I'm getting really interested in that, because I'm usually not trading what I call the first initial momentum move, so the first rally of 50 to 70%. What I would like to see is that the stock pulls back a little bit, that institutions are supporting now the stock around key moving averages. And when the setup's right, when the thing is really, really tight and compressed in price and then breaks out on the upside, that is usually the pattern that I trade. And that can be in a larger pattern, like a cup and handle, for example. That could be a shorter pattern, like a flag pattern, where this price is only consolidating maybe 3 weeks. And then I'm getting in. But, sometimes also when I thought about 2024, SMCI as an example, the stock made a big move, a big rally, and then went sideways, I think, for a couple of months, and then broke out from such a base. And then I get into that. So I'm a breakout trader. 90% of my trades are breakouts from classical chart patterns.
Mm-hmm. In the documents you shared with us, you say in there, poor execution destroys the inherent edge that a trading strategy provides. So what kind of execution are we talking about? I mean, the difference between the bid and the ask, or just the price of the day? I mean, what do we know about an execute? What's a good execution and what's a bad one?
Yeah. No, it's not bid or ask prices. So I'm not so short term. When I always say, the trader destroys their own edge. It's not a big issue to find a trading system that has an edge. Trend following it gives you a basic edge, and you can build rules around that and make money with the system. So, but it's a trader that has to execute the system. So, and the trader itself is the biggest enemy between, or the biggest enemy to become successful. It's mostly that you destroy the edge by making mistakes, emotional mistakes. I give you one example, right? I think last week I opened a trade in a stock called INOD. It was a very strong day on that day, and I bought not only this stock, but I bought also a couple of other stocks. So, and in hindsight, when I did an analysis of the trade and asked myself, okay, was it now a really good trade or not? Then I came very quickly to the conclusion, no, it was not a great trade. It was not meeting 100% of my criteria. It was a mistake. So, and this is what I mean by bad execution. You know, when you are trading, you're always influenced by emotions, by other things that go in around, and you are coming very quickly out of your performance zone, or what I call the performance zone, you know, and then you start to do mistakes. You trade mediocre setups, you get sloppy in your stock selection, especially if you have a very good run in your trading. And this is what I mean by bad execution. And the trader itself destroys the edge. No one else is destroying the edge. It's always that you have to look at your own shoes and ask yourself, okay, why I'm performing not as I would like or as I think I could do. And then you have to do the homework and find out how can you execute your trades or your trading strategy in a better way, that you are, you know, meeting more your rules and your criteria. I'm not a robot, you know, I'm a human, and I make mistakes, and I will always make mistakes in trading. And I have no big problem with that, because the monetary impact of my mistakes is very limited, and I can undo mistakes very quickly. So by closing position or whatever. But of course, I also know traders who make mistakes, and, you know, it costs a lot of money because they are not able to close the trades very quickly, where they are starting to lose a lot of money with.
So then the self-sabotage, could we call it that, of what, being sucked into a trade because of what, overconfidence of how you did in the past, and oh, this time it's different, and the ego takes over. I mean, what are the what happens there?
Yeah, absolutely. It's self-sabotaging. You know, I know that from my own. To be honest, the toughest periods in my trading is not a drawdown. It's when I'm performing good. This is the toughest periods for me, because I have to sit really down, do my mental preparation every day, and really try to focus on not becoming overconfident. Because when I had a very good run, like this May as an example, and when I had a very good run, I start sometimes to take more mediocre setups. And then you start to come into a drawdown, or you lose multiple times in a row because these setups are not working the same way. And this is something where you always have to sit down, focus, manage yourself so that you are not getting sloppy in your stock selection, and try always to be 100 or 110% focused on your trading. And to be honest, this is really, really hard work. To do that over a long period of time, you know, weeks and months, is really, really hard. And this is you know, why I and also a lot of other traders always say, you know, trading is a mental game. It's 90% a mental game, because you always have to put so much energy in managing yourself, in managing your reactions, in being mindfulness, etc., so that you are not self-sabotaging yourself. You know, overconfidence is a big problem.
So is it simply just putting in a stop loss order? Can we simplify it to that level, or what other factors are involved?
Yeah, the problem is never the technical side. You know, everybody knows how to put in a stop loss order. Everybody knows how to close a trade that is losing. It's just clicking a button, right? But it's about the mindset. When you have a trade that goes against you, and I'm not speaking about myself with 20 years experience, but if you have a more inexperienced trader, let's say with 3 years or 5 years experience, and they have a high expectation about a trade, and then they are starting, or this trade goes into the other direction, and then hope is taking over, right? They hope, okay, it's now down 10%. Oh, it will come back. Let's give it some more time, etc. And then sooner or later, you're sitting in a big loss, And I mean, it's always a cliche, right? You can read that on social media, etc. Use stop losses and let only a stock go 7 or 10% against you, etc. So, but I have seen traders who sit for weeks in big losing positions and were not able to close them. Every time when your emotions are taking over, it becomes more and more difficult to do good trading decisions. That is self-sabotaging, what we spoke about before, right?
How much does position sizing play into this?
I learned risk management very, very early in my career. I learned that from one of the first guys I was working with. I have a very simple rule of position sizing. In good market periods, I invest 10 to 15% in one position, in one stock position. In more bad times, let's say when the market is going sideways, I invest rather 5 to 10%. So I'm also using different position sizes. Sometimes when I have a high conviction trade, but more in very mature and very liquid stocks, I can also go up to 20% position size. So Tesla as an example, or Nvidia. Last year I had a 25% position in Nvidia, but only because I was able to place a very tight stop loss, and it was a very liquid name. When I trade more a story stock, I can also go down to 5% portfolio share, or 5% of my trading capital in a stock. The thing is, what I'm always asking myself every time when I take a position is, what would I do if the position gaps 20 or 30% against me? And what is the damage to my trading capital? And when I invest, 10% or 15% in one position, and it gaps down 20% against me, that is a loss, it's not great, but you can come back from that. Mm-hmm. So, but if you have a big position size, like 30 or 40% in one stock, and it gaps 20% against you, then it's getting more harder to come back from that. And that's something, I see with younger traders. They always use too much leverage. They jump into options. They take big position sizes, because usually they want to make money very fast, and that leads to a disaster, because it is always a two-sided situation, right? If the thing gaps against you, you never think about that, but it can happen. Then you suffer a big loss.
Mm-hmm. So did you suffer big early losses when you first started out and learn these lessons early, or?
I never crashed an account, to be honest. I never crashed an account because I learned risk management very, very early. When I started out as a trader, and when I became more interested in stocks, it was not 23 years ago, but a little bit later. When I got interested in stocks, I met one guy from the UK. He was a technical and very systematic trend follower. And I was fascinated by that, because he was, he had a rule set and was just trading by rules. And he was always emphasizing risk management, always, how important that is, how to size positions in the right way, etc. So I learned that very, very early from scratch. And that's why I never crashed an account. So, but, of course, I had up and downs in my equity curve. And it's always a process over time. And what I learned over time is, the more you eliminate mistakes in your trading, like, for example, letting losses run or something like that. If you eliminate such a mistake, you're getting better and better, and your equity curve goes more up in a steady way. It's never about changing the trading system itself. It's more about eliminating mistakes over time and then you make progress also as a trader. Of course, sometimes you also have to really change something in your trading system if you have no risk management at all, for example. But it's more like, or for me, it was more like a journey of eliminating a lot of mistakes over time, and then become better and better and better in trading.
So have you ever encountered a situation where you go through a drawdown for an extensive period of time, and then you think, well, maybe my system, I need to tweak my system, I need to adjust it, or do you just stick with it because you've been doing it for so long and you're comfortable with it that you know eventually it'll turn around?
Yeah, I'm totally honest with you. I still have today moments where I think, oh my God, do I really have an edge? So I mean, it's the self-doubt and always being at a very high level in your confidence as a trader is not easy, to be honest. And it's not so much the drawdowns or sideways periods that that has an impact on my confidence. It's more like making mistakes or making not the progress that I would like to see, or trading not up to the level where I think I am as a trader. These are the moments where I have doubts about my abilities as a trader. I always say that you have to reset yourself. You have to bring yourself back into the performance zone. And this is something which I'm always doing. When my equity curve is going sideways, let's say for 4 weeks as an example, my self-doubt is taking over slower and slower and slower. And then I'm bringing back myself into the performance zone. And that mostly means to make a reset, to not trade for a couple of days, then to go to my rules again, to go to my trading journal, to have a look at my chart book. So I have a chart collection of hundreds of charts where I exactly noted, okay, this is the pattern from a big winner, etc. So, and then I'm getting more my confidence back, and then I start to trade or take new trades again. But I'm 100% sure that all traders sooner or later have moments where they have doubts about their own trading and about their own trading skills. But it's more about managing yourself, in my opinion, and to bring back yourself into a performance zone.
Well, it sounds like you have a great faith in your system, given that the kind of position sizing that you would take with NVIDIA or Tesla or any stock, right?
Yeah, it's not so much about the system itself. I mean, the system is very simple, right? I have some rules: when to take profits, when to enter a stock, how to manage the position size, how to manage the portfolio, etc. So, but when I have a lot of confidence in a stock like NVIDIA or SMCI last year, then I can also increase the risk a little bit. Instead of risking, let's say 0.5 to 1% of my trading capital, I risk a little bit more, like 1 to 1.5%, because when you have a very, very good trading opportunity and it meets all of your criteria, then I'm also willing to bet a little bit more and also take a larger position size. That it has more to do with having conviction in the stock itself, that this is the right stock at the right time, instead of my abilities. But because I manage all the trades the same way, it's not that I traded the NVIDIA trade differently than my trade, than other trades, as an example. But sometimes, I'm a discretionary trader, and with the experience, when you observe and trade the markets for 20 years, you develop something like intuitive. Or something like intuition, right? When you look always at the same type of companies for many years, you intuitively feel that this could be the right stock at the right time. And I learned one thing, and I know that a lot of traders will probably say no to that, but you have to trust your intuition. I always say that my brain consists of 3 parts. I have the logical brain, I have the emotional brain, and I have something like a pattern brain, right? And sometimes when I look at a chart, it speaks to me. And sometimes I look at a chart and the chart says to me, yeah, I cannot really say that, but I have a very good feeling about a chart. And that is something where intuition comes into play. And every time when I went against my pattern brain, I lost money. Every time when I had a bad feeling about a stock, but I made a bet on that and I bought the stock, it went against me. And every time when I have a very good feeling about that and I increase my position size in the stock a little bit, then it's really going for me.
Oh,
So
wow.
this is call that a sixth sense, but I call that just experience and intuition. And I very often say that to people: never ever underestimate experience in trading. This is really important.
So, share with us a little bit about your trading performance over the 20 years that you've been trading in different types of markets, and kind of how your performance has changed over time.
Yeah, I personally don't like to speak so much about performance, to be honest. When you look at social media as an example, all the traders who post their performance on social media, and when I'm getting in contact with my followers and also the people from my own community, I know how frustrating that can be to look at these results and probably never achieve that, or probably never be or compare yourself as a trader. And I'm also suffering sometimes these moments where people post something on social media and I know some of these traders. Then I'm looking at the result and then I ask myself, oh my God, why was my year last year not in the exactly same way? So this is something where I personally don't like to speak about performance, and because I know how much harm performance comparison can bring to traders. So and I can share my results here from May, because I'm also more openly with my community about that. This year was a very good year, to be honest, until now. The only exception, of course, was the January 27 DeepSeek event. But for example, in May we had so many great stocks that moved higher, and I was up alone 50% in May this year. So, but
wow,
when I share that, when I share that with other traders, everybody's saying, yeah, great, etc. But I know that a lot of people look at that and say, okay, is that something I could achieve? Why I'm not achieving that, etc., etc. And it causes a lot of emotions. And I know that from the discussions and with other traders. And also I know that, by myself, how frustrating that can be if you always look at performance.
I see. So you think that the risks or the dangers of this comparison that other traders would make. So, well, why can't I make 50% in May too? That risk is greater than what could be achieved through inspiration. The flip side of saying, hey, well, now I have a goal to shoot for, and maybe I can achieve that someday, maybe not now, but that we should focus in on more of the risks to the mind of a trader rather than the opportunities.
Absolutely. I'm working with traders one-on-one and in groups for many years right now. And every trader is differently, and I see that with traders I'm working with, that they have total wrong expectations. And, I'm a different trader than other traders, because I have a different personality. I'm sometimes a little bit more aggressive or defensive. Other traders that I know also very good are more aggressive with me. They sometimes have better results or a higher result, not better, but a higher result. Then I know other traders who have not the same performance. They are more conservative. So, and how can you compare all these different things together? If you just look at the performance numbers, it probably gets very frustrated. I will not have the same performance like a day trader, maybe in a year. And a long-term investor will not have the same performance as me, as an example. And I think it's so important as a trader to find out what is my personality? How can I execute a trading strategy without doing a lot of mistakes, and then look at nothing else and just execute your strategy? Be happy with with what the market gives you and what you can achieve as a trader. And I can also share another thing with you without mentioning any names. When we look sometimes at the US Investing Championship, and I have a high respect with everybody who attends the Investing Championship. I know guys from this Investing Championship which had one great year, but never ever again. So, and this is something, where just the focus on performance alone leads to total wrong expectations, in my opinion, and more to frustrations than getting or helping traders with inspiration, right?
I see. So in other words, it's very highly customized to the personality and the person involved in their risk factors and what have you, and that's what we should be focusing on, right?
Sure. And also, if you just look at the performance results, I'm not a day trader trading Latin American stocks or Indian stocks or anything like that, and they will have a different performance like me. And, if you are maybe an event-driven intraday trader trading for a prop firm or a hedge fund, you also have a different performance, I think the most important thing, and that's what I'm always trying to do, is compete with myself and not comparing yourself with other traders. Every time when I do that, every time when I compare myself with other traders, it's always a feedback that I'm probably looking for making more performance or anything like that. And every time when I change something in my trading approach, I start to lose money. Every time when I change to a more short-term view, where every time when I think, okay, yeah, Julian, maybe you should hold your stocks rather 3 to 5 days instead of a couple of weeks, something like that. Try to make more money. Every time when I do that, I start to lose money because it's not meeting my personality. It's not what I am, right? And this makes it so hard also to compare yourself with other traders.
So what would you describe what you just shared with us as your biggest challenge as a trader, or is there something else?
My biggest challenge as a trader is to always be 100 or 110% focused on my trading and on my setups. This is the biggest challenge. And I mean, that I'm also running a community. That I'm also very active on social media, etc. And I cannot or I cannot isolate myself 110%. That's not possible, right? And this is the biggest challenge. You always get influenced by everything, by something people post anywhere, by reading the news, whatever, you will be influenced. And this is something where I always try to focus myself 110% on my own trading, doing always the same things over and over again, having a long-term perspective on my trading, etc. And this is very, very hard to maintain over a long period of time. And that is my biggest challenge, to be honest, right? Always being 100% focused, Yeah.
Fantastic. Well, Julian, I'd like to thank you for coming on Chat with Traders.
Yeah, thank you very much for having me.
Yeah, fantastic. And how can our listeners get in touch with you?
Yeah, of course, on social media. You can find myself on X or Twitter. You can also find myself on juliankomar.com. And I'm always open to contact. So if people have questions or want to contact me, they can do that every time on my website or on social media.
Great. Thanks for coming on the show.
Yeah, thank you very much.
What do you think is the most powerful part of your trading process?
Stock selection and research. Find high potential stocks and making no compromises, saying no to 99.9% of all stocks. That is the power, because you can have a stock, which gives you some some buffer of being wrong. If you buy a really, really good stock and it moves higher, and you bought it maybe a little bit too late or something like that, and it goes higher and higher, it's not a big issue. So selecting the right stock at the right time, that is really my biggest power, to be honest. I personally think that every trader has something unique. Every trader has a superpower inside. Every time when traders approach me and say, how can you teach me, blah, 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 and we have one-on-one mentoring sessions and etc., they always try to be me. And I always say to them, stop doing that. This is bullshit. It's not working. I can also not be Mark Minervini. Over time, we discover something together that they have unique powers. I'm working with an Indian trader, for example, who is a software developer. He developed his own indicators, etc. I'm working with an Australian trader who has a lot of deep knowledge about Australian companies. That's an edge. You can use that, right? And it's the same thing with me. I have a natural connection to technology companies. I understand what they are doing. I am very motivated also to find out what is a quantum computer and how does the quantum computer work. So, this is something which fascinates me, and this is, why I can select stocks with which has a very high potential. And that's also the reason why I sometimes can say, yeah, Google is probably not the company that you should or I should trade.
Here, I asked Julian about his thoughts on AI currently and how it might impact us as traders these days or in the near future.
If AI would be so good at the moment that they could trade the market in and out, we were all jobless, to be honest.
Yeah,
that's a reality, right? Trading AI is not at that level. The thing is, what I am interested in a little bit in AI is, maybe AI could do some research. We're discussing that in my own community, and some people are trying that out. And for example, using ChatGPT to sum up business models. What is the business model? Is that innovative, etc.? They are using something like that. The answers ChatGPT are giving me and giving my members is absolutely nonsense. I mean, you can find that out in 1 second if you go to the investor relation website and have a look at that. And I don't see that at the moment, but that must not be that it will not come in future. I could imagine that AI will play a role in future in selecting stocks or maybe also analyzing chart patterns. But it's a bit. This is a question I recently discussed it also with a financial journalist. Why is AI not doing all this technical analysis stuff for us? Chart patterns as an example. I don't know any software right now where AI is so good that it can really, really do good analysis of chart patterns.
Maybe not yet.
Yeah, but because how AI works and how machine learning works is in quotes is very dumb at the moment. It's not so intelligent, and nobody of us is able to finance a data model from Palantir or whatever. So it's very basic, and chart patterns itself in the stock market, it always morphs. These chart patterns, they have so small details sometimes, which separates a good chart pattern from a bad chart pattern. And I mean, AI is currently, or the models are not trained enough for that. And to be honest, probably in 20 years, we will trade differently. Yeah.
I honestly think that it's going to happen soon. Like AI is going to get smarter and smarter, but it's more like, how are we going to be prepared as, traders, especially discretionary traders, and maybe we can use it to our advantage when it gets to that level. But I always think that it could happen really fast, and we just have to be prepared and maybe make it our friend and use it. It's just another tool.
But what is the consequence of that? Because, I don't recall the name of this effect. The Lindy effect. The Lindy effect says if something is there for a very, very long time, it has a very high probability that it will stay a long time. And you know, when I go back in charts, I have charts from 1700, you know, the South Sea bubble, etc. The stocks are showing exactly the same patterns as today. So I think the probability that the patterns will stay the same for a very long time in the future are still very high. So, and of course, I could see AI as a tool which is helping me to make better decisions as a trader, but I highly doubt that it will change the market itself, because the AI models are still developed by humans. We had similar situations in the past, you know, where everybody was screaming about high frequency trading, etc. That will change everything in the market, blah, blah, blah. The patterns did not change. So it's always the same thing. And I'm not sure where I read that, but there was an article or something like that where the author exactly also wrote about that. We will probably develop AI algorithms that trade the same way as we are trading today, because of course we know how to analyze the chart patterns, etc. And we are only using AI to do that. But AI is probably not reinventing a total new way of trading. That's why it will never change the market structure. So that's how I see that. So we are prisoners of our own minds.
Here, I was thinking back to what he shared with Ian earlier in the interview about one of his worst trading experiences relatively recently. And I wanted to know how it still can affect a seasoned trader like himself and how he bounced back.
This is really an exceptional event. I never, ever experienced something like that. And there are two answers for that. The first is from Paul Tudor Jones, who said, you know, forget your losses quicker than your winners, because the losses are always impacting you more or stronger than your winners. And the second thing is, the question is, where is your focus as a trader? And I always compare that with a professional sportsman. You know, if you are playing on a field, soccer player or whatever, and you always think about a last game that you lost, you will have a very hard time to play a good game in the present. So the first thing what I was doing is to restart my equity curve for the year. So that means I don't want to look at this big down day all the time when I look at my equity curve. So that is the first thing. So my equity curve this year starts on February the 1st. Of course, you know, when of course I have a second chart where also this dip is included, but you know, I don't want to look at that all the time because it will always impact me. And yeah, so that was the first thing what I was doing, you know, remembering what Paul Tudor Jones said about that, and also other interviews that I read where people said, you know, you must really restart and look into the future. And that also includes not looking at this big down day all the time, right? And then the second thing, what I was doing is really, you know, focusing on playing the same game again. So it was not that I was trading differently from that time on. It was more like, okay, be more selective. That's one point, but you know, waiting for the right thing. And I analyzed. That's maybe a good point. I analyzed the event very, very much. I went through all the trades. Did I do something wrong? Did I oversee something? Yes, okay, this stock was maybe a little bit more extended, etc. And what were the learnings? And I asked myself, okay, is it something which could repeat in the same way in the next 1-2 years? And I came to the conclusion, probably yes, but because I never experienced it exactly in the same way in the past, the probabilities are probably not so high that I will exactly experience the same thing again in the future. Yeah. I mentioned that during the interview that I said something like, yeah, you know, you have the most difficult, or I have the most difficult periods when I was doing very good. So, and that's also something I learned. I plotted Bollinger Bands on my equity curve. to see when I'm really doing good. When I see that my equity curve comes back after it was outside of the Bollinger Bands for a couple of weeks and it's coming back into the Bollinger Bands, that is a sign for me to take or to cut back a little bit exposure and probably get off margin, etc. This is something I don't feel, but it's more a technical reminder for me to manage my emotions. And it's the same way, I also have other rules around that. For example, if my equity curve goes below the MA20, or if I have a losing day where my portfolio is going down more than 4% in one day, I always have actions around that. It's the same thing like this deep sea event. When I have a losing day like that, I don't hold these positions very long. I want to get rid of these positions very quickly. Because on one side I want to be in cash. That's one point. But on the other side, the longer you hold such a position which is going against you, the more it has also an impact on your mindset. And if you are in a bad period or if you are in a bad mood, mistakes repeat. You are making more mistakes if you are not 100% in your performance zone.
What would you say sets you apart from the other 90%? And then do you believe, is it possible that more traders these days can change these statistics?
What sets me apart, to be brutally honest, it's the edge that I have. Because, the 90% of the traders, they probably have an edge, but they are not able to execute that. And I went through so many years where I always improved my trading and made mistakes and learned from that, etc. And that's, how I was able to bring the edge more and more to life. But that sets me apart. The most traders, they have an edge, but they are not bringing them to life. And maybe another answer to that is I always took trading extremely seriously. And that's something, which I can see from other traders today. They are not trading, they are not taking trading serious enough. They always think, I can do that, aside from everything else. And I can be the best sportsman and I can be the best father, mother, and I can, I have all the information about the news, Netflix series, blah, blah, blah. No, you can't do that. Trading needs so much attention. You are learning a new job. And, I've been part-time trader for so many years, and trading was always extreme important for me. And I planned my life around trading. I have been on business trips and I was sitting in the morning in the hotel room and in the evening in the hotel room and planning my trades. And sometimes I was not at a company event because, I needed to do some trading work, etc. It's really, passion, and that I really, really know that at the end I will be successful with that.
But do you also believe that, for the rest of us still developing, that, we always hear these statistics, 90 or 95% of traders fail. But these days, I think there's an advantage because we have a lot more tools that we never had even just 10 years ago, a lot more information, a lot more mentors, at least access to trading communities and mentors and all this information. So with all this, do you think that, that you might see a change in the statistics in the coming years?
I don't think so, to be honest. I don't think so. Yeah, because more information, better tools, whatever, will not make you a better trader, or it will not help you. I could also trade without any tools, right? It's not about tools. It's not about monitors. It's not about hardware, software, whatever. It's about, taking a very simple trading system. There are so many trading systems out there, even in books or magazines or YouTube or whatever, but nobody is able to trade them. They all have an edge. So, but it's really about, discipline. It's following the rules, building up confidence and conviction in yourself, in your trading method, finding something where you're compatible with. And it's the same thing like, 100 years ago. And that will not change. It will not change with tools. And, we are seeing that also with these robot trading services or whatever. It does not mean that they are more successful than discretionary traders, because people can override their own systems, etc. It's always about the human factor, and that will not change, in my opinion. And I see that with young traders. I don't see any change with that. More information is not helpful. I can say one thing from my experience with working with traders. The traders who make the most progress that I work with, they are the quietest person. They are very systematic in how to learn trading. They have very realistic expectations, how long it takes and what it takes. Yeah, they are very strategically going through this learning process of trading. They know exactly what they have to learn. They know what are the challenges, etc. And the people who mostly are very loud and want to make money very fast, they are probably will not make it very long time.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.